I want to talk a little bit about gardening. I want to talk a little bit about farming. You kind of got to weed your garden, don't you? You kind of, when you grow crops, you have to grow them at the right time. Like if I told you to plant corn in the fall, does Bobby know anything about corn?
Not a clue. I'm just going to sit here and agree with you and score points with you. Just be agreeable.
These are the farm boy analogies. If I told you to grow corn in the fall, you don't do that. There are some certain things that you do.
Why?
And that you don't do, because then the corn's in the ground, and when the winter comes, it kills your corn. And then you don't get any.
In the spring.
But there's a lot of farmers out there that don't get any of that stuff. Kind of like Bobby doesn't get any of that stuff.
I'm a city girl.
I had these clients that came and met with me back when I was a financial planner back in the day. And they were farmers. Everything they had was cash. And they either had lots of cash if the crops had just come in, or they had none. And one day, the farmer said to me, he said, "Did you hear about the farmers who won the $1 million lottery?" And I said, "No, I didn't." He said, "Well, they farmed it until it was gone." Live from my mom's half-finished basement and from somewhere above Manhattan, in the kitchen in Manhattan. I'm Joe Saul-Sehy. This is Bobby Rebell.
Hey, everyone.
And this is Money in the Morning, the show where we go over not one, but two headlines ripped from the financial press. And boy, do we have some headlines for you today. And not only will we read them like they do on some other podcasts, we'll actually talk about what they mean to your wallet. And as if that's not enough, you know what we do at the end of the show? We take both of them and we combine them into a big idea that you can take and use for the rest of the day. Isn't that amazing?
It's amazing.
Today's episode is brought to you by M1 Finance. Free automated investing, a brokerage built for today's investor. M1 Finance empowers you to manage your money and build wealth with ease. Just create and automate your portfolio, and they'll take care of the rest for free. Head to stackybenjamins.com/M1 Finance. And thanks to everybody who's used our link that's done it already, because that helps us keep podcasting. We've got a fantastic show, Bobby. We got a great time. And different than those people hanging out with us here live on Facebook saw, we're not going to talk about Cheese Factory.
No, we're not.
We are not. Sorry.
Not. This show could be a little controversial, though.
The general rules, if you want to talk about Cheese Factory, you get here early. If you want to stick to the topic, just listen to the audio show, because Laura kicks it off just like this.
Here are today's Money in the Morning headlines.
Deanna, speaking of the Facebook group, hey, Deanna, is hanging out with us live. She says, yeah, getting a farmer to invest in the stock market's like getting more hair. It generally,
I don't understand that.
It means it doesn't happen.
Plain Joe.
I have tried to get more hair, and look at this. I've successfully, you know what? I do get more hair, Deanna. I get it in my nose and in my ears. And that is the only thing. As I get older, I apparently can grow hair in the worst places. But anyway, we won't get into that too much. Let's get into instead let's be from the Motley Fool. This is written by Todd Campbell, Jamal Carnett, CFAs, and Nicholas Rosalillo. 3 stocks to buy and hold for decades. Okay, before we even get into this.
Now you're set, Joe.
That's
you're good to go.
That's all I need.
That's all you need.
I knew when I saw this, and it's funny because I texted this, well, we use Slack, but I Slacked this to Bobby, and the first thing Bobby said was this.
The dumbest headline of the week.
She didn't use those exact terms.
No.
But you kind of went off about how kind of dumb even that idea was.
Yeah, I did, because basically they're saying decades, meaning at least 20 years, and really the implication is 30 years. And when you look back at the stocks that were the big stocks 30 years ago, they might be a little different from what we see today.
Slightly. And you've pulled together some of those stats, which we'll get to in a moment, but let's read some of the piece at least. Microsoft, MasterCard, and Alibaba are very different businesses, but they do share one thing in common, the piece says, the potential to reward investors with long-term growth. 3 Motley Fool contributors weigh in on how managing mountains of data The war on cash and increasingly wealthier emerging markets could lift these stocks in the coming decades. They start off with Microsoft, a big company with big opportunities. Todd Campbell writes, "It's no longer about a PC on every desk. Now it's about technology that allows individuals and businesses to compile, access, and analyze data faster, more comprehensively. Information is increasingly being distributed across devices rather than constrained within silos, and Microsoft solutions, including cloud computing, artificial intelligence, machine learning, and unified experience such as Entertainment Anywhere initiatives, can make this already giant company even bigger in the coming decades. Investors are already beginning to see the benefits of Microsoft's investments in these areas. In fiscal 2018, Microsoft generated $110.4 billion in revenue and $35.1 billion in operating income, and it returned $21.5 billion to investors via dividends and share buybacks. Its commercial cloud sales exceeded $23 billion. Revenue for Azure, its hyperscale cloud, nearly doubled, and gaming revenue surpassed $10 billion for the first time in company history. It goes on to show that momentum isn't slowing in the next paragraph, and in the last paragraph it says, overall, Microsoft has proven it can adapt and capitalize on opportunities, known and unknown, and that makes it one stock I think should be in just about everyone's long-term portfolio. The fact that it is among the deepest pockets in technology, or that it pays a dividend, doesn't hurt for buying it either. Exiting last quarter, $136 billion in cash and investments on the books, and currently its shares yield a respectable 1.8% dividend. So nice,
Right. So,
thick dividend.
yeah, I want to make it clear. We're not passing judgment on these specific three stocks. Microsoft has been a good performer. I looked back, we'll get into this. I looked back 20 years. What were the stocks that were being talked about as hot stocks? And Microsoft, which has had ups and downs in between, was in there. So we're not saying anything negative about Microsoft, but I do want to point out something. And I think the strongest part of this piece is the fact that there are disclosures at the end. And the author of that section of the article, a gentleman named Todd Campbell, he does disclose that he owns shares of Microsoft and the next stock that is in the article. So at least they are being honest that they do have an interest in people buying the stock. And I think that's an important, it's good that it was included. I don't know if I like it that he's clearly has a bias, or would, because he owns the stock, but at least it is disclosed. So I commend them for the disclosure.
I got to tell you, Bobby, when I was a financial planner, one of the easiest things to do was to tell the positive story about why you should own anything. Like, I could tell you about how you should own this microphone and about the way it picks up my voice, all the positive things. And it's funny because a lot of the analysis, when you analyze a stock, if you're going to own individual stocks, you analyze them against competitors. And certainly I agree with everything that Todd says in this piece about Microsoft. Even when you look at Microsoft versus competitors right now, Microsoft looks like a fine stock for a lot of portfolios. So I buy that. But you did some research about decades. And decades is a whole different issue.
Well, that's the whole thing. So I thought back 20 years, and I pulled up, for example, I'm in a Wall Street Journal piece from talking about the best stocks of 1998, and it talks about tech stocks ruled the roost in 1998, and it talks about, I just lost it. But it basically goes into the stocks that were big stocks at that time. And it does mention Microsoft. It mentions Cisco, Lucent Technologies, and Dell Computer. It mentions America Online as a big stock. Yahoo was a big stock. And then it also goes into other stocks that were big, like Ubid and theglobe.com. So some of those, did do very well and some didn't. I just think there's so many variables. And especially Microsoft has had a roller coaster ride at times, and their leadership changes have made a big difference. So to say this implies at least 2 decades, that's a very long time. And the other point that we talked about before was that the reason that people are told buy and hold is because they're being pointed towards indexes. So when you buy and hold an index, the index actually, you think the Dow is the same as it always was. You think the S&P is the same as it always was, but it's not. It's actually adjusting for the times. So for example, as recently as last June, Walgreens Boots Alliance replaced General Electric. So if you thought General Electric, which was in the Dow, I think since 1907, that is no longer there. It's replaced by something that, for whatever reason, the people that make those decisions made that switch. Obviously, GE has had a lot of changes recently. Apple replaced AT&T in 2015. So if you buy and hold an index, that will make adjustments as time goes on to reflect what stocks represent the mainstream cross section.
That's
what the markets are. In individual stock, you really have to monitor. You can't just buy and hold it for 3 decades. Well, and that's the implication. 3 stocks to buy and hold for decades.
Yeah, it isn't the implication. It's what it says right across the top of the piece. Decades are a long time. The thing that's interesting to me, I had a gentleman talk about this one time on the Stacky Benjamin show. Talked about how about how indexes naturally are going to rise because as companies become the worst companies in the index, they get taken out of the index.
Yeah, Sears got dumped.
Yeah, it's like this self-cleaning oven,
Exactly.
where it takes care of itself. Let's go over just a little bit the 3 of these. I think we made our point, but MasterCard. Nicholas Rosalillo writes, according to the 2018 World Cash Report published by multinational security services firm G4S, the vast majority of transactions around the globe are made in cash. That's especially the case in areas where banking and technology infrastructure are limited. Though printed money is ancient technology, the use of cash rises as wealth and economic development increase. Forms of electronic payment are rapidly on the rise, too. Electronic payment are rapidly on the rise. When taken into context of the thousands of years currency has been in existence, electronic transactions are still a fresh idea. Enter MasterCard. Household name, worldwide leader in digital payment processing, the plastic money company, which earns a cut for simply facilitating a transaction rather than lending money itself, has an enterprise value of $190 billion as of this writing. It also has a staggering operating profit margin of 54.3% through the first 3 quarters of 2018. Those 2 items paired together could be a reason enough to make MasterCard a core portfolio holding. MasterCard's proof that big doesn't equal boring, though, with digital transformation only just beginning in many countries. There's plenty of growth left in the tank. During the 3rd quarter of 2018, gross dollar volume, that's the total value of transactions, went up 13% from a year ago, leading to a 15% increase in revenue and 36% increase in earnings per share. Earning a fee every time someone swipes a card or makes a transaction online bearing the MasterCard name is a simple business model, but it's worth noting that model could suffer during global economic downturns, and it talks about maybe some potential downsides. Do you think that buying a stock that's big now, I mean, both of these companies, the author makes the point that these companies are big now, right? Todd led off with that.
Decades again.
Yeah.
And the next one we're going to get to even more. There's even more peril in this one. I was shocked to have this in there. And just to go over the disclosures, because that is my favorite part, this author that wrote this part, Nicholas, he does not own this stock, but he does own Microsoft and the next one we're going to talk about.
The Alibaba.
But his colleague, Todd, does own MasterCard.
Owns MasterCard. Yeah. Jamal Carnett, CFA, writes, Alibaba shares have had a disappointing run of late. Shares have declined 19% over the last year as Chinese macroeconomic concerns have spooked Wall Street. Instead of viewing this with apprehension, long-term investors should view this as an opportunity to buy a multi-decade growth story at or near the cheapest valuation in years. The buy thesis is rooted in favor. Well, I don't even want to go into that. When a stock's down, a stock is down for a reason. And I get the whole Chinese.
Sometimes there's momentum and whatever, but in this case, yes.
Yeah. I mean, I get the Chinese
uncertainty going on there.
Yeah. The Chinese macroeconomic thing I get, but stocks are down for a reason, and parsing out that whole reason is well,
and in the universe of stocks, these are the 3 that are going to be the best for the next decades, plural. I mean, I don't know that, I'm not saying again that these stocks are bad, but these are the very best ones these are going to, you can just buy and hold these. You're good. 30 years, Joe.
I know. I think they're fine. They
down to your kids,
They may be fine for the right risk tolerance today,
right?
But 30 years or even 10 years. I mean, 30 years ago, Eastman Kodak was a monster company. Mm-hmm. And look at what happened when my cell phone got a camera.
Yeah, exactly.
Eastman Kodak couldn't do it. Look at how much, companies, I know I get accused of talking about Disney way too much, but look at how much Disney's changed over the last 30 years.
Right. A lot of the companies that have really done well have changed and adjusted their business model. I mean, in some of the articles that I read, they were talking about Amazon, the money-losing fledgling online bookstore.
Right.
So, they worked it out.
They might be okay.
Strategy.
Yeah, they might do all right. at this
They
point.
might do all right. I mean, I'm looking at this like, so even let's go back a decade. A decade ago, Chevron and Bank of America replaced Altria and Honeywell. Chevron had been a Dow component from 1930. And then it was off recently. And then in 2008, also Kraft replaced AIG Group. 2009, Travelers and Cisco replaced General Motors. I mean, there's a lot of transition going on in what the stocks are that are being given the most attention and the most promise, because that, as you mentioned, is what they put in the indexes, which is part of what helps them rise.
Dylan is hanging out with us in the Facebook group. He says he's putting all his money on Sears and Gymboree. That's I feel like Dr. Phil, Dylan, when I say, so how's that working out for you? It's gonna be a big win for Dylan. I always like it. By the way, we hang out here, as you've already heard, with some really fun people who hang out with us on Facebook. If you want to hang out with us while we make these, head to facebook.com/iStackBenjamins, because Steve's here. Steve says throwing GE out of the index. Deanna is here. Kathy's here. She wants you to look up more so they can see.
Oh, I know.
Your
I
eyes.
had a technical problem. I'm sorry about that.
Chris is here. He said he always cringes when he sees an article pop up from the Motley Fool. I actually like a lot of the Motley Fool articles, Chris, but there are a few of these that the Motley Fool insist on, these forward-looking articles, like how things are going to be, like they're some type of Nostradamus. I have no idea, but a lot of responsible people.
Clickbait. Jeff.
Yeah, maybe. Well, and
optimized.
You said this earlier, though. The author doesn't often write the title. So the author may not have thought up that title. Some editor did.
The three authors may not. They might have just been asked to write about a stock that they think has longevity. Or, they may have been approached to write something like that. And then a third person not named here could have written the headline. That's absolutely possible.
Well, and that's why I'm not sure that it's the dumbest piece, because it goes over these three companies, which is fine, but it is the
dumbest headline of the week.
The headline's dumb. Shame on the editor for that one. Not good. Let's move on to our second piece, which comes to us from USA Today. So I see, Bobby, there's a special section
what does that mean? I'm curious what our Facebook audience thinks that means when they say, so this is the headline, why the stock market is headed for a swift recovery. It's by Ken Fisher. Well, it says Ken Fisher, then there's a little break. It says special to USA Today. What does that mean, guys?
I don't know. I don't know if it means this is an advertising piece or not. Ken Fisher, by the way, for people who don't know, big money management dude, has a big organization. People get a lot of mail from Ken Fisher. He advertises in a lot of different places. I don't know if he's a great money manager or not. He's obviously good enough to continue to advertise. So I don't know how well Ken's stuff is done. But when I see special to USA Today, and it even has different formatting, but it doesn't say advertising anywhere on this piece.
And it does not say in partnership with, it doesn't say paid content, it doesn't say sponsored content. So at least as a reader, I have to believe this is editorial, right? We don't really know, but it's presented as such.
Yeah, I don't get it. But I did think when I saw this headline, which by the way, I saw 4 minutes after I sent this to Bobby, 4 minutes after I sent the first one, I thought this also vied for
the dumbest headline of the week.
Like, really? Why the stock market's headed for a swift recovery? Let's read, Bobby, about why Ken Fisher says the stock market's going to have a swift recovery. He says, welcome to my last in a series of columns on the year ahead. Thank God I missed the first 4, by the way. Because I can't take this stuff.
You're very judgy today, Joe.
I am very judgy. I am. In my 4 earlier ones, he says, I covered why December was lousy and why stocks are on the right side of a swift V-shaped recovery. I don't like this when somebody, and Ken may be the smartest guy in the world, I don't like it when somebody pretends that they know all the reasons why December was horrible, and then they know all the reasons why 2019 is going to be fantastic. And
there's a lot of confidence in this piece.
Did you, Rick Edelman, one of my favorite books, and I know I'm getting off track here a little bit, but Rick Edelman in his great book, The Truth About Money. And if you haven't read The Truth About Money, it's a phenomenal book on financial planning. But Rick talks about a stockbroker who does kind of, he does this great thing. He mails 5,000 people, and he tells them, let's take Microsoft, since it was the first stock that was in that last piece.
It's also going to be the best stock for decades.
Oh, get this. He takes 5,000 people and he mails them something, right? It's one of these mailing programs where he mails 5,000 people, says, hey, I'm a great stockbroker. I can pick good stuff. With 2,500 of them, he tells them Microsoft's going up. With 2,500 others, he says Microsoft's going down. And then he emails the 2,500 back a week later where he was right. He says, hey, I'm going to call this Microsoft's going down, let's say. And Microsoft goes down. Then 2 weeks later, he emails or mails back just the 2,500 where he was right. And he goes, hey, I called the last one. I'm going to make you a second call because apparently you don't believe me. And then let's say the second piece in this was what? MasterCard. Then he takes MasterCard. 1250, he says MasterCard's going up, and 1250 says MasterCard's going down. And then he says, hey, call me because I'm giving you two freebies. And then after the second one, he just emails the 1250 where he was right and goes, I've been right twice. I'm a genius. And he keeps doing this. And he's like, I can't believe you can't figure out that I'm a rocket scientist. I thought it was, there's a little bit of this though. Maybe he is a
genius to figure out that marketing idea.
When you talk about how well the markets or why the market did what it did, I just think you're kind of playing a little bit like, well, here's why it did all that. Okay. Sorry, Ken. I mean, maybe, Ken's a smart. I have seen Ken be interviewed before, and he's a smart guy, but okay, let's get to the piece.
I don't know.
We'll get to the piece. So he covered why December was lousy, and why stocks are on the right side of a swift V-shaped recovery. U.S. stocks have climbed more than 10% since the market closed on Christmas Eve, accompanied by wild wiggles. The rest of 2019 should be similarly happy. On December 17th, I explained how stocks have averaged 34% before dividends in the 12 months after all of history's correction bottoms, meaning a drop of 10 to 19.9% in the S&P 500 index. Assuming December 24th remains the bottom, this correction ended later in the calendar year than any correction or bear market ever. An average aftermath now would make 2019 simply stellar and surprise almost everyone. That's bullish. Maybe December 24th wasn't the bottom. We can't know for sure.
He's giving himself a little bit of an out. Do you notice that?
There's
a little bit of an out here.
Absolutely. Yes. So if you disagree, if things go bad over the short term, Bobby, covering his bases. But there were abundant bottomish signals. Mutual fund outflows reached levels only associated with major market bottoms. That's true. December outflows matched March 2009 when the last bear market ended. U.S. stock market liquidity sank like a brick, also echoing prior lows. Price to earnings ratios contracted last year. Earnings soared while stocks fell. A simple secret, basically every year valuations shrink, the next year they expand. So unless earnings fall, stocks rise. Analysts expect 6.9% earnings growth in 2019. Earnings almost always exceed analyst estimates. Expanding valuations on top of earnings growth would cause big positive stock returns. Okay, he goes on to explain, and by the way, does it pretty damn well, talks about why things are going to go well. But you can't invest on this. But you can't invest based on.
First of all, it's a very well. The article's actually decently written. I think that he makes really good points, and it's a thoughtful article. It's the certainty conveyed by the headline that I think is really bothering us, and by the initial part of the article, especially, is so adamant that he is right, and this is going to be a V shape, and boom, you better get in. And it always just makes you a little bit wondering.
Yeah, I don't.
What's the, is there a reason he's presenting such a strong point of view?
There's a much better way to invest, which is look at the time frame on your goal, look at investments historically that have done that, and ride those investments. Instead of playing this, I mean, imagine your stomach if you're playing this year by, what do you think the market's going to do? What do you think that do you think
are we in this year, or are we out?
I mean, you were right in the middle of that, being in the media on Wall Street. I mean, That's
Well, and I do wonder the agenda. I mean, there was a famous analyst that I think made a call that a certain tech stock was going to hit $400, and it really made his career. So people can make these big calls sometimes just to get media attention. And usually, if you make a positive call and the stock doesn't hit that number, you're forgiven. If you make a negative call and it doesn't, then sometimes you can be more beaten up because the companies get really mad at you. And you're usually okay if you're positive and wrong. If you're negative and wrong, you get beaten up. So there's not a lot to lose sometimes when people make these very bullish calls.
Let's talk. Speaking of who's making the bullish call, we talked about the authors of the last piece. The author of this piece manages stocks for a living.
Yep.
His goal, and I don't know if this shades his writing or not, his goal would be to have you invest. And when's a great time to invest? When you think that the ugliness might be getting close to behind you, it's a phenomenal time to invest. The perfect person to present that, a guy doing what Ken Fisher does.
Yes.
And
doesn't mean he's wrong.
And it doesn't mean he's a bad manager.
Right.
Guy's all over the place. So,
yep.
But it still is. I got to play this one more time.
The dumbest headline of the week.
Bob's here. Bob says, sounds like it's time to go all in with my dry powder. Time to go all in. Once again, I feel like the doctor, what could, how's that working out? Deanna says that is so wrong. Dylan says that he learned something once from Rick Edelman. That's one thing more than you learned listening to me. Dylan says, my goal is to be the subject of this segment one day. Dylan wants me to be all like down in the mouth about him. As if I'm not already, Dylan.
Hey, Dylan.
Dylan's like the Newman, Do you ever watch Seinfeld, Bobby?
Dylan. Yes, I have actually.
You know the whole, hello, Newman.
Yes, I do.
Like, hello, Dylan.
Hello, Newman.
Yes. Good stuff. Well, you know what is good stuff when it comes to your portfolio is, and you don't have to play these games if you use M1 Finance, because M1 Finance is a place where you go to make long-term investment decisions instead of these short-term decisions. While trades are free, the cool thing is you organize your portfolio in pies. So you're organizing an entire portfolio instead of betting on just a couple stocks. So if you are a long-term investor instead of a day trader, M1 is a great place to diversify your portfolio. And then when you're ready to realign your portfolio, what's called rebalance your portfolio, you just press a button and it automatically goes back to those percentages you set up at the beginning. So stackingbenjamins.com/M1 Finance gets you there. And thanks to everybody who's used our link because that's how we keep podcasting.
Yes.
Bobby, we got a big so what today?
It is big.
A big
Except
idea.
you had to explain it to me.
I did have to explain it. My big idea, maybe I'll do that today. We'll do this a different way. I'm going to give you the analogy first. We started off talking about gardening and talking about farming, but you got to weed your garden. And this is another farm boy analogy. Like you can't just put the corn in the ground and expect that 30 years from now, it's just going to be there. You have to pull the weeds for the good stuff to grow. And you know what? Sometimes your portfolio is going to do something a little different than you think it will do. And you have to adjust. I like all those faces you're making. You have to adjust. I think it makes so much sense. It makes so much sense to me that you would engage in this idea of planning instead of just having a one-time plan. Don't just buy a stock and say 3 decades from now it's going to be here. Don't take Ken Fisher's word for it that the next 12 months is going to be brilliant and phenomenal. Stay on top of your money. And it doesn't mean, Bobby, that you're making all kinds of wild and crazy moves. But how hard is it to just a couple times a year look at where you're at and decide what's weeds and what's the good stuff? And she's got nothing. Do we have a Bobby? I think we lost her. That's going to do it for today, everybody. We'll see you next time back here on Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor and second, having your head examined. Have a headline you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.